You know, I mean, in essence, the Hunt brothers should have, the environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence, me versus you. And if it breaks, there's no one there to step in per se. Yeah, I think volatility is a tool of the cartel. Volatility within a range is what they've been using forever. They use things like volatility. They use things like counterintuitiveness as an example. Everyone would have thought that the stock market should have got its rear end kicked and gold and silver and Bitcoin and oil should have gone straight to the moon during the acceleration of the bombing between Iran and Israel. And of course it did the opposite. But going back to the Gulf War, when I don't know how many years ago the original Gulf War was, I don't know, it was probably right at the very beginning of my career. It had to have been close to 30 years ago, if not longer. The exact same thing happened. They delinked the rationale that people use to run to these assets. Whenever we would expect it to move in one direction, typically it goes the other. And this is part of the ploy that they use. But volatility is another. They use volatility within a range to keep people on the sidelines and to delink the rationale that we've all grown up into believing that gold and silver are tools or safe haven tools to protect our wealth and our finances in periods of uncertainty and chaos. Well, that's cartel 101. But yeah, I would expect, and Jeff Clark did a great piece many years ago where he talked about, and he went back and looked at all sorts of markets throughout all sorts of history. And the common theme was that as markets reach a blow-off stage, as they really accelerate, you see much greater volatility, that the bull wants to take as few people along for the ride as possible. If it were that easy, well, everyone would be wealthy. And it's not that easy. But this is even bigger. This is a changing of the guards. This is a reorganization of the global monetary system. And there are players that don't want this to happen and certainly don't want to make it easy. So yes, I would expect greater volatility, but within a range. And that's kind of what we've seen. Great volatility in gold and silver, but within a range, and lately higher lows and higher highs. So all very bullish to me and all to be expected. And no one should expect this to be easy. We're talking a monumental shift away from, basically a new monetary system that if anyone would expect that to be easy, I think they're fooling themselves. So yes, greater volatility is absolutely something we should expect to see. And when that happens, it's better just to shut off your computer, don't look at your phone, go outside and do something, come back a few days later, and you'll see it's right back to where it was. And we've seen that recently. If you go back over the last few months where we see the smash downs, where gold falls by $100 or $200 over a few days, you come back 2 weeks later and it's up higher than it was. That volatility within that range is what keeps everyone, oh, nothing to see there. I'll move on and go back to my risk-on trade like NVIDIA and Bitcoin, where you have the largest retail allocation to equities ever in the history of the stock market. At the same time, we've been seeing on average $2 billion worth of sales by the institutionals every week since beginning of June, and a continual selling since the beginning of the year by the institutionals. So you have the biggest money in the world fleeing, selling into strength that is a byproduct of mom and pa retail all in on equities. Now, what could go wrong there? At the same time, you have the inverse of that in the gold market. The biggest money in the world accumulating, standing for delivery, and repatriating, as the ma and pa is all in stocks and doesn't even know a gold coin when it falls on their feet. So my point is that if you believe that the institutional traders will be wrong on both sides, well, more power to you. It's been my experience that the institutional traders aren't just the wealthiest, they're the most well-informed. And I think that's something people should think about for a moment. Massive participation in equities, not much in the way of commodities for the retail massive positioning in commodities, including deliveries off the exchange and repatriation by the banks and the central banks, and the lowest continual low allocation to equities and selling huge amounts every single week since the beginning of the year into that environment. What could go wrong? So that's that volatility as well. But the people who are pulling the strings, they know the playbook, and they're moving out, like Warren Buffett, as the public's moving in, and the same exact thing is happening in reverse in the commodity market. I don't know the answer to that question. You know, I mean, in essence, the Hunt brothers should have, the environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence, me versus you. And if it breaks, there's no one there to step in per se, unless they get all of the members to do it. Whereas on COMEX, it's a different thing. It's a different animal. They can just, in essence, create a force majeure, shut it down, say no more deliveries, or do what they did in London when you saw the nickel problem. They just invalidate everything. We're getting to the point where that will happen, where whether it's outright default, it'll appear the exact same thing, and it will be settled in a manner where you would say, well, this was done to avoid a default. And, you know, I think that if we wait for that moment to happen, you can see that they're doing all they can right now to keep that from happening. We get to that point, yeah, if the COMEX were to default, the entire precious metals complex breaks down. And I think that ultimately where you will see things change is you're beginning to see the development and the maturity of other exchanges in Dubai, in Shanghai. You'll see the BRICS development of the BRICS metals exchange. You'll see the Moscow exchange. These exchanges now in Singapore, these exchanges that are coming up throughout Asia in particular, and the BRICS network, will be more of a cash and carry, reflective of real price settlement. And it's almost like these players are trying to exploit as much as they can through delivery using the Western system until the Western system breaks. And whether it breaks by outright delivery default on one of the two exchanges is debatable. But I think in essence, whether we get to that point and see it or just realize it was inevitable before they came in and stepped in to protect themselves and changed the rules, the way they did under the Hunt brothers, where they said you can be as short as you want, but only long a certain amount, like 1 million contracts or whatever it is. And then anything over that amount, they were forced to sell. And that's what drove the price down. Now that is manipulation of the exchange to protect itself and screwed the Hunt brothers. Well, something like that I would expect would happen before you'd see one of these big banks blow up. But in London, no, I think in London you could see a default by a very large institution, and there will be no one in there to step in to rescue. It's a fair question. I can't really answer it definitively, but simply to say it seems like we're getting closer and closer to that moment, to be honest with you. You know, it's kind of like when I started in this industry 35 years ago, the Fed used to publish, or the Bureau of Labor Statistics and the Fed used to publish something called M3. Which was the broadest measure of the money supply. And under Bernanke, he got rid of it, saying it was an archaic number that no longer needed to be published. It wasn't significant. But what that was the ability to measure the amount of money that was entering the system. And of course, for convenience reasons, they cite it was too costly, no one used it anymore. They got rid of it. Well, it's the same thing here. I remember, I don't know, 7, 8, 9, 10 years ago, I did a presentation in at the time it was the Vancouver Agora conference, which has subsequently been changed to the Rule conference. Mm-hmm. And there's a man named Dmitry Speck, and Dmitry Speck is a brilliant, brilliant man. And Dmitry took a chart of 10 years worth of market movement and condensed it into one chart. And what he would show would be the AM and the PM fix, and all of that movement over 10 years worth of trading into one chart. And what you saw when you looked at that chart was truly breathtaking. And I could probably dig that up maybe for the next time we talk. And that is simply that it would go like this. AM fix, bang. And creep back up, PM fix, bang. And PM fix as you're heading into New York. These two waterfall events. And then as you hit New York, it would slowly rise in through Asia, hit the UK again, and bang, and bang. And that's not how markets work. And I think it's been the stated, I think, mission of those bankers to suppress the price using the AM and the PM fix, and largely as it heads into New York with one arm tied behind its back. So that doesn't surprise me at all. And again, it speaks to more desperation. When you have a market that's trading 200 million ounces of gold per day with like 10 times less gold behind it, and as much as over 3 billion ounces per day, almost 4 times global mine supply annual per day, with a float 12 times less than it's there, you want to do all you can to blur. And it's the same reason that they lie to us about inflation and full employment. These are the metrics that the Federal Reserve is supposed to do policy on. And if you're trying to base your policy and your indebtedness off of low interest rates and stable employment, you're going to lie about it. Well, the same thing is true here. And again, it's just the realization, the sad realization that the people playing the markets, I guess I'll just simply go to what Chris Powell, and we all owe Chris Powell and Bill Murphy a debt of gratitude. I don't say it enough. Those two gentlemen who started GATA, the Gold Antitrust Action Committee, and Chris is famous for saying there are no free markets anymore, just manipulations. Well, the same is true with information. And we see that coming out of the Bureau of Labor Statistics. Now we see it coming out of the Bank of England. It's just more of the same. So I think this is where I've come up with the statement, you have to trust your gut. You can see it, you can feel it, doesn't matter what the numbers say. They're caught and they're afraid. And that's why the Bank of England or the European Union, the European Central Bank has come out and said that the gold demand, the gold market, is actually a threat to the entire global financial system. Well, that's right, it is, because you have massive amount of contracts that are standing behind just a little bit of gold, or the other way around, a little bit of gold and silver standing behind a massive number of contracts that are now standing for delivery. This is what he's talking about. It's another way of saying, yeah, we got caught with our hand in the cookie jar. And so they're going to do all they can to blur that information from anyone who's trying to figure out a strategy. Doesn't surprise me one bit.